Welcome to the deep dive. Today, we're jumping into some foundational wisdom, really the bedrock of modern value investing. We're talking about the philosophy of Benjamin Graham.
That's right. And our mission here is to pull out the core ideas that, separate a truly intelligent investor from just a speculator who's chasing quick wins.
And if you're looking for some secret formula to, I don't know, win the market next week, this probably isn't the right place.
No, not at all. Graham's work is much deeper than that. It's more like a survival manual.
Mhm.
It's about how to minimize your chances of those catastrophic, irreversible losses.
And on the flip side, how to maximize your shot at sustainable long-term profits.
And, maybe most importantly, how to stop being your own worst enemy.
Right. And I think the key insight, the thing we should get out right away, is that Graham believed financial success isn't really about being a genius or having a sky-high IQ.
Yeah, he said it was, and I'm paraphrasing here, more a trait of character than of the brain.
Which seems so counterintuitive, doesn't it? You think of Wall Street and you picture these, brilliant minds.
You do.
Yeah.
But history is just littered with examples that prove his point. I mean, look at the failure of long-term capital management, LTCM, back in '98.
Remind us who was behind LTCM. These weren't amateurs, were they?
Oh, not even close. This was probably the most intellectually stacked hedge fund of all time. We're talking mathematicians, computer scientists, and not one but two Nobel Prize-winning economists.
The guys who literally wrote the textbooks on modern finance.
The very same. And yet they lost over $2 billion in just a few weeks. They made these massive leveraged bets that the bond market had to return to what their models called normal.
But the market didn't listen.
The market refused to comply, and their debt got so big it almost brought down the entire global financial system. So all that genius, it failed because they lacked the character, the humility to admit that their models could be wrong.
So if a high IQ doesn't save you, what's the one skill Graham would say you absolutely need to have?
It's the ability to control yourself, plain and simple. The investor's biggest problem isn't the market, it's emotion. It's always emotion.
Fear and greed.
Fear and greed. When they take over, disaster almost always follows. I mean, think about Sir Isaac Newton.
The Isaac Newton, the apple, gravity.
That guy.
That guy. The man who invented calculus. He lost a fortune in the South Sea bubble. He sold early, made a profit, then watched his friends get richer and richer.
Oh, so he got FOMO.
He got FOMO. He jumped back in at the absolute peak, letting the mania, the crowd, override his own, world-class judgment.
And to help us deal with this emotional battle, Graham gives us this wonderful little story, this parable of Mr. Market.
It's one of the most useful concepts in all of finance. So imagine you own a small piece of a private business, and you have a partner, Mr. Market.
Okay.
He's a great partner in some ways, but he's also severely manic depressive.
So he has his good days and his bad days.
Big time. And every single day, he shows up at your door and he names a price. He says, I'll buy your share from you for this much, or I'll sell you my share for this much.
And his mood dictates the price completely. Some days he's just bursting with enthusiasm, shouting a price that's way, way higher than the business is actually worth.
And other days?
Other days he's terrified, he's depressed, and he'll offer to sell you his stake for pennies on the dollar. He's just convinced everything is doomed.
And the key lesson here is you don't actually have to do anything.
Exactly. That is the critical step. The intelligent investor realizes they are under zero obligation to trade with him. You just thank him for the quote and close the door.
You treat him as a servant, not a guide.
A useful servant, but never, ever a source of wisdom. This idea, it completely flips how you should think about risk.
Right, because most people feel safest when stocks are going up and up in a bull market. They feel like they can't lose.
And Graham says that is precisely when things are most dangerous. An investment becomes more risky, not less, as its price goes up.
And less risky as the price goes down.
Absolutely. The intelligent investor actually fears the bull market's crazy optimism. And they welcome the low prices that come from fear, because that's where you find safety.
Let's talk about a real-world example of this. The story of the retailer A&P is just incredible.
It's a perfect case study. So back in 1938, A&P was a huge, profitable company. But there were these fears, the government might put special taxes on chain stores, that kind of thing.
So Mr. Market panicked.
He had a complete meltdown.
Yeah.
The entire company was selling for a total market value of just $126 million.
Which sounds like a lot, but what's the context?
Well, here's the amazing part. The company's net current assets, so that's cash, inventory, what it's owed, minus its short-term debts, was $134 million.
Wait, so you could buy the whole profitable company for less than its spare cash and inventory?
For less than its liquidation value. The business itself, the stores, the brand, all of it, was essentially free. It was a gift that nobody wanted because they were too scared.
Okay, now fast forward to 1961. What's Mr. Market's mood?
Oh, he's euphoric. The fears are gone. Optimism is everywhere. The public is desperate for A&P shares, and they've pushed the price up to a staggering multiple, something like 30 times earnings.
Which was much higher than the overall market at the time.
Way higher.
Yeah.
And there was no real justification for it in the company's results. It was just pure, irrational optimism.
And we know how that story ends.
Of course, when the hype dies down, the price has to correct. The stock lost over half its value in the next year. It just proves the point. You make your money not when you sell, but in the discipline of the purchase.
Controlling that impulse to just follow Mr. Market's mood, whether he's euphoric or terrified, is so, so important.
It's everything.
And you know, if you find this kind of guidance valuable, these insights that help you focus on what you actually can control, please take a second right now to subscribe to the channel and give this deep dive a like.
Yeah, that simple, disciplined action on your part really does help us bring more of this kind of content to you.
So speaking of discipline, let's shift from managing our emotions to managing our capital. What's the practical tool Graham gives us for that?
He gives us a very powerful strategy, and it's essential for what he calls the defensive investor. It's dollar cost averaging.
Right, DCA. Can you break down how that works for someone who might be new to the idea?
Sure. It's really a systematic, almost automatic technique. You just commit to investing a fixed amount of money, let's say $200, at regular intervals.
Every month, every quarter, something like that?
Exactly. And you do it no matter what the market is doing.
Yep.
Up or down, you invest that same $200. It takes all the emotion out of it.
So if the market drops, your money buys more shares.
Right. And if the market goes up, it buys fewer shares. Over time, without even trying, you automatically lower your average cost per share. You're naturally buying more when things are cheap.
And the Great Depression is maybe the most powerful proof of this concept.
It really is. I mean, imagine two investors. They both start in early 1929, right at the peak of the market.
Okay, the worst possible time to start.
The worst. Investor A puts a lump sum of $12,000 into the S&P 500. 10 years later, after the crash and the long depression, that $12,000 is worth only $7,223.
Ouch. What about Investor B?
Investor B starts with $100 and then invests another $100 every single month for 10 years.
So their total investment is about the same, $12,100.
Almost identical. But by August of 1939, their portfolio is worth $15,571.
Wow. So they made money through the worst crash in history.
They succeeded because they were disciplined. They kept buying at lower and lower prices all through the 1930s. That is the power of dollar cost averaging.
And for most people today, the easiest way to do this is with low-cost broad index funds, right? You just sort of give up on trying to guess winners and just buy the whole market.
It's the perfect application. And we are living in a golden age for this kind of defensive investing. The tools are just so cheap and accessible now.
You mean online brokers and things like that?
Exactly. And DIRPRIPs, dividend reinvestment plans, or direct purchase programs, they let you make these small, systematic investments automatically, often with no minimum balance.
Which is huge for new investors. You can just set it and forget it.
Now, there is one small catch. If you're only investing, say, $50 a month and the fee is $4, that's a huge percentage. So you have to be mindful of transaction costs.
Right. But for people starting out, it's one of the best ways to build a diversified portfolio with that crucial discipline baked in.
And when you're building that portfolio, it's important to remember how Graham connects diversification to his other big idea, the margin of safety.
How do those two work together?
Well, the margin of safety protects you on any one individual stock. But diversification is your insurance policy against the unknown.
Meaning that bad things can happen to even a good company.
Exactly. The future is uncertain. There will be recessions, wars, unexpected inflation. You can't put all your eggs in one basket. By owning a bunch of different, carefully chosen stocks, you raise the odds that your winners will more than make up for your losers.
Okay, so we've covered controlling ourselves and building portfolio discipline. Now, what about the external threats, the traps set by companies themselves?
Yeah, you have to be vigilant. You have to learn to spot the accounting red flags that show a management team is more focused on the short-term stock price than the long-term health of the business.
What are some of the big ones to watch out for?
Be very wary of anything a company calls a non-recurring charge that somehow seems to recur every year or two.
Or an extraordinary item that isn't very extraordinary.
Right. It's often just an attempt to hide normal business costs to make the main profit number look better than it really is.
What about all the acronyms they throw around? I mean, everyone loves to talk about EBITDA.
Ugh. EBITDA. Earnings before interest, taxes, depreciation, and amortization. It can be useful for comparing companies, but it is so dangerous when management presents it as the main measure of success,
Why is that?
because it ignores real cash costs. Interest payments are real. The cost of replacing your old machine's depreciation, that is a very real cost of doing business.
So focusing on EBITDA instead of actual net income is a way to distract you from the real bottom line.
It can be, yes. Same with pro forma earnings, where a company just invents its own accounting to exclude costs they don't like. We saw this with companies like Quest, who had to admit they overstated their earnings by over $2 billion. You have to stick to the traditional conservative numbers.
And it's not just the accounting, it's executive behavior too. Graham wanted managers, not promoters.
Yes, a manager's job is to build a long-term value of the enterprise. A promoter's job is just to pump the short-term stock price. And today, a lot of their pay is designed to make them promoters.
You're talking about stock options.
The stock option problem, it creates a massive conflict of interest.
How so? Why are options bad for the regular shareholder?
Well, an option becomes more valuable when a stock's price is highly volatile, when it swings around a lot.
Okay.
Now, what's one thing that tends to reduce a stock's volatility? Paying a steady, reliable dividend. So an executive with a ton of options is actually incentivized not to pay you a dividend.
And instead, they'll use that cash for stock buybacks.
Precisely. Buybacks can still boost the stock price, making their options worth more, but they don't have that same stabilizing effect as a dividend. It's a self-serving loop that often prioritizes their pay over your return.
So as an owner, you have to use your vote.
You have to. When you get those proxy proposals, Graham would say you should vote against any pay plan that gives management more than, say, 3% of the company's shares, or any plan that isn't tied to achieving great results over a long period, like 5 years. You have to hold them accountable.
So if you put it all together, the whole deep dive, the main lesson really seems to be about control.
It's all about control. The intelligent investor controls what they can, their costs, their patience, their discipline, their asset allocation, and they refuse to rely on predictions about the market.
Graham called that absurd pretense.
It did. Because the future is always an unknown. You can't pretend to know what will happen.
And that leads to a really clear, practical takeaway for anyone listening. If all this analyzing stocks, reading financial statements, looking for red flags, if it all sounds like way too much work,
Then you might just not have the time or, frankly, the temperament for it. And that's okay.
knowing your own limits is a form of intelligence itself.
It absolutely is. And in that case, the best, most disciplined thing you can do is just stick to a low-cost total market index fund. It's a simple, powerful way to own a piece of every worthwhile company.
In the end, investing is this lifelong journey, isn't it? Navigating a future you can't see. But Graham's principles, they're like a compass. They make the journey safer.
They do. He loved an old allegory from Dante's Inferno, where Ulysses is urging his crew to sail into the unknown. He tells them, "Consider the seed from which you come. You were not created to live as beasts, but to follow virtue and knowledge."
That's powerful.
And that's the choice. The intelligent investor chooses virtue discipline, patience, and knowledge over just following the frantic emotional herd. And that is the character trait that really pays off in the end.